bearish rejection block. But the issue here is that since buy-side liquidity is available above the rejection block, we cannot judge the extent to which the price will extend itself to sweep the liquidity. There are occasions where the wick of the retest candle breaks above the bearish rejection block significantly. So it is always recommended to patiently wait until the liquidity run is over and the price starts to show signs of a retracement or a reversal. Then only we should initiate a short trade. I don't really appreciate the idea of placing limit orders and stop losses way before the price has tested the rejection block. In such scenarios, there are high chances that your stop loss will be taken out. So be a little mindful about it. Now, talking about targets, you can set your take profit level as any of the nearest support areas or demand zones where the price could potentially face a rejection or a pushback. Now, let's talk about bullish rejection blocks. A bullish rejection block is formed when the price quickly drops to a low point but then rebounds sharply, suggesting a rejection of lower prices and a potential upward trend. So effectively, for a bullish rejection block, we are looking for a swing low. That is, we have to find the lowest candle whose low and close prices are lower than the low and close prices of the neighboring candles respectively. In that case, the tail or the wick of this lowest candle will be our bullish rejection block. Usually, we consider a 3-candle pattern in which the middle candle has to be the lowest of them all. The color of these candles are not really significant, but what is important is that the low of the middle candle has to be lower than its neighbors and the close price of the middle candle should be lower than or equal to the candles on the right and left. If these conditions are fulfilled, then we can plot the entire lower tail or wick of this middle candle. This will be our bullish rejection block. So after sweeping the liquidity below the lows and forming a price rejection, we can expect the price to swiftly move higher. This tells us that the big institutions were involved in this move. It is worth mentioning that the area near the lowest wick or the bullish rejection block still contains a lot of retailer orders waiting to be executed. These include a cluster of sell stop loss orders and sell limit orders placed by those reversal traders who bought from the demand zone and those breakout traders waiting to sell below the support area. This is why we can expect the price to return back to this rejection block to absorb the sell side liquidity. So when the price comes back to test the rejection block, we can look to take long trade entries. We can also make use of the 0%, 50% and 100% Fibonacci retracement levels to place our buy limit orders. We can set our stop loss below the bullish rejection block. Here also, the issue is that since sell side liquidity is already available below the rejection block, we cannot really judge the extent to which the price will go deeper to sweep the liquidity. On some occasions, the wick of the retest candle breaks below the bullish rejection block so significantly that even if your analysis was spot on, you would still end up on the losing side due to an early trade entry. So it is always advised to patiently wait until the liquidity below the rejection block is absorbed or waiting for a clear rejection signal, and when the price starts to show sign of a retracement or a reversal, then only we should enter trades in the direction of the rejection. This would mean initiating long trade positions. Now, I don't generally agree with the idea of placing buy limit orders and stop losses way before the price has tested the rejection block. In such scenarios, there are high chances that your stop loss will be taken out. So trade logically and mindfully. Now, when it comes to targets, you can set your take profit level as any of the nearest resistance areas or supply zones where the price could face a rejection or a pushback. So that is all you need to know about rejection blocks. In SMC, rejection blocks stand as a crucial tool in deciphering the market trends and making informed trading decisions. The key to success lies in accurately interpreting these blocks within the broader market context and using them to pinpoint optimal entry and exit points. So make sure to learn the concepts properly, backtest it on multiple charts and on multiple time frames to see if it actually works for you. Today, we are going to discuss two important concepts in SMC. These are liquidity voids and vacuum blocks. Liquidity void is a concept that I should have covered in my video on fair value gaps because these are very much related. But liquidity voids share similarities with vacuum blocks, given how and when they are formed. So in this video, I will talk about liquidity voids and how they are different from a fair value gap. Then we will talk about vacuum blocks and their formation. We will also investigate the reasons why liquidity voids and vacuum blocks are formed on the charts. We will also look at the different types of liquidity voids and vacuum blocks. And finally, we will briefly discuss what to expect from these areas. This is going to be an interesting video, so watch the video till the end. And if you are benefiting from these series of video tutorials, make sure to give a thumbs up to show your love and support. Also make sure to subscribe to our channel to get the best trading education. So without wasting any time, let's get started. I have mentioned that fair value gaps and liquidity voids are related concepts. Let us understand this first. So, if you have watched my video on fair value gaps and imbalances, you already know what this is. In that video, I have mentioned that after the price reaches a liquidity level and then reverses from it after sweeping the liquidity from that level, what will often come next is displacement. The fair value gaps are created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances are visualized on the chart by a 3-candle sequence containing one large middle candle whose bordering candles' upper and lower wicks do not overlap. So, a bullish fair value gap is a 3-candle pattern where the high of the first candle does not overlap with the low of the third candle, leaving a gap in between. Similarly, a bearish fair value gap is a 3-candle formation where the low of the first candle does not overlap or cross the high price of the third candle, thereby leaving an imbalance in between. In this definition, what you have missed is the term displacement. Displacements are nothing but liquidity voids. So displacement in short is a very powerful move in price action resulting in strong selling or buying pressure. Generally speaking, displacement will appear as 2 or more strong candles that are all positioned in the same direction. These candles typically have large real bodies and very short wicks, suggesting very little disagreement between buyers and sellers. Or in other words, there exists an inefficiency in prices. Often, a displacement or liquidity void will occur just after a liquidity level has been breached and will often result in the creation of fair value gaps and a market structure shift. We can also think of displacements in relation to fair value gaps. At least 2 back-to-back fair value gaps will indicate a strong push in prices resulting in a displacement. Usually, these liquidity voids or displacement moves form after a period of consolidation and then the price suddenly moves up or down very strongly, printing one or more large-bodied candles. This means liquidity voids are areas on the price chart which is characterized by a lack of significant trading activity or volume. They typically occur after a rapid price movement, leaving behind a region in the chart where the trading was thin or almost non-existent. This phenomenon often happens because most market participants were not interested or were not able to trade at these levels, either due to a lack of perceived value or because the market moved too quickly for them to react. You can see this phenomenon every now and then across all different time frames. The peculiar thing about liquidity voids is that they almost always fill up. And by filling, I mean that the price will return to the origin of the void. The reason for this is that during the void formation, an imbalance or inefficiency is created in prices that has to be balanced. The erasure of this imbalance is what we call filling of the void. And while some liquidity voids waste no time in filling, some others take multiple periods before they get filled. Now let's take a look at bullish and bearish liquidity void formation. Here, you can observe how prices crash down from a consolidation area. The price formed a group of big bearish candles with large real bodies and little wicks as it moved lower. Clearly, the selling pressure is the dominant force here. There was literally no buying activity here. This means there is an inefficiency in the market. This is a typical case of sell-side imbalance and buy-side inefficiency, or in short, SIBI. I know I have asked you to relate SIBI and BC to fair value gaps, but the definition of SIBI and BC holds true for liquidity voids also. This means there were not enough buying transactions to counter the selling pressure, leading to a sell-side imbalance, and the lack in buying pressure remains as an inefficiency that needs to be filled. So we can expect the price to return back and fill this bearish liquidity void that was created. Do not expect the price to fill the inefficiency all at once. It will generally take time. At the first stage, we can expect the price to return back to fill the 50% of the liquidity void. Then it might come back again to fill the rest of the imbalance. So a typical example of this bearish liquidity void can be observed on the 1-month time frame of Nifty chart during the Corona crash. You can see two big candles crashing lower, generating an imbalance. But over the course of the next few months, you can see how the price returned back to mitigate the imbalance caused by the liquidity void. I won't be giving you any trade entry methods or strategies in this video. This is just a conceptual video to get your SMC basics right. We will talk about different strategies and risk management techniques in the second season of the SMC course. Anyways, in a similar manner, we can identify bullish liquidity voids. Here, you can see how the prices explosively moved up higher from an area of consolidation. As you can see, the price formed a group of big bullish candles with large real bodies and tiny wicks as it moved upwards. It is obvious that the buying pressure is the dominant force here. There was no effective selling activity to counter this price rally. This means there is an inefficiency in the market. This is a clear case of buy-side imbalance and sell-side inefficiency, or BC. What this means is that there are not enough sellers or selling transactions to counter the immense buying pressure, leading to a buy-side imbalance, and a lack in the selling pressure remains as an inefficiency in the market that needs to be mitigated. So we can expect the price to come back and fill this bullish liquidity void that was generated. As mentioned before, this void filling won't have to happen abruptly, but over time, these liquidity imbalances will be dealt with. If we draw a Fibonacci retracement containing only the 0%, 50% and 100% levels connecting the high and low of the liquidity void, then we can anticipate the price to fill at least till the 50% of the imbalance in the first stage. Eventually, the price will fill the void entirely. You can take a look at this example to see how the buy-side imbalance was completely filled over the course of time. The great thing about trading liquidity voids is that they are present across all time frames, and so they can be used across all these time frames. The implication of this is that traders of all trading styles can hope to benefit from it. Intraday traders can go down to 15-minute chart to trade them. Scalpers can even go as far down as 1-minute chart, and swing traders can also take advantage of liquidity voids on the 4-hour and even higher time frames. Now, let's just briefly talk about how to approach our trades to benefit from these voids. If you have understood what liquidity voids are, you may already have an idea of how to trade them. You know that since the void almost always gets filled, your hope is in trading the fill. And how do you trade the fill? Or how do you know when the price is about to reverse to fill the void? So the first thing to look out for when attempting to predict where the price may start the void filling reversal is to look for liquidity zones before the void. These liquidity zones or pools are often in the form of supports and resistances. This is where you can expect the price to reverse from and fill the gap. Another way to spot areas of potential reversal for filling of the void is to look for liquidity zones that have developed after the void. Now, you will find the price going up and down around this zone. However, you can only use this method when the filling of the void does not happen abruptly. That is, the price consolidates for some time, creating a liquidity zone that can be tapped into. Now let's move on to the second concept, which are vacuum blocks. As the word vacuum suggests, there is a complete absence of trading activity. By definition, it refers to a specific area on price chart where rapid price movements has occurred, leaving a noticeable gap or vacuum in the market. Unlike liquidity voids, where there was either a dominant buying or selling pressure, resulting in an imbalance in prices, vacuum blocks are associated with no trading or transaction in between, leading to gaps in the charts. In the price action context, these are called price gaps, and in SMC, it is known as vacuum blocks. Just like liquidity voids, Vacuum blocks also represent inefficient price action. These vacuums are crucial in predicting future price movements as they often act as magnets, drawing the price back to these zones for a retest or to fill the gap. Let me explain this. In practical trading, a vacuum block operates by leveraging the market psychology behind sudden price movements. When price rapidly moves away from a certain level, it often leaves behind a region with little or no trading activity. This is a vacuum block. These are formed as a result of any high volatility event or news or even during session openings. Most experienced traders would monitor these areas as they can act as magnets for future price action. So when the price revisits or retests these zones, it can trigger a strong reaction, either continuing the initial trend or reversing it. The price revisits this vacuum block to fill the inefficiency in price action. But keep in mind that not all gaps are filled completely, and some gaps take a lot of time to get filled. Vacuum blocks are also classified into two types based on its formation. These are bullish vacuum blocks and bearish vacuum blocks. A bullish vacuum block is a gap created in price action when price opens way higher than the previous candle. To mark the vacuum block, we have to consider those two candles between which the gap was formed. Then, we need to mark the highest point of the first candle and the lowest point in the second candlestick. This will be our bullish vacuum block or simply a gap up. Now, a bearish vacuum block is a gap created in prices when the market opens lower than the previous candle. To mark a bearish vacuum block, we have to consider these two candles between which the gap formation took place. So all we need to do is to mark the low of the first candle and the high of the second candlestick. This will be our bearish vacuum block or simply a gap down. These gaps are formed due to liquidity vacuum, which is directly related to any events. You can see these sorts of gaps forming every now and then in our Indian indices, which is primarily due to overnight sentiments following some global or domestic events or news. Occurrence of such vacuum blocks are comparatively rare in case of forex markets because these markets function almost 24/7, so every news is factored in. Due to this, we might see a lot more liquidity voids getting formed rather than vacuum blocks in forex markets. This is another area where liquidity voids and vacuum blocks are related. Both these areas are formed as a result of some volatile event in the market. Usually, these are related to some news that induces a lot of buying or selling. This increased number of buy or sell orders at any given prices will result in price keeping certain price levels, resulting in a vacuum block in case there is a time delay between the market close and the market open. And in other cases, if this surge in buy and sell interest happens during the market hours, it will result in large candles in the same direction, resulting in an imbalance or a liquidity void. I hope things make sense. Now, if you want to know how to make use of this vacuum block concept to take your trades, you can watch my video on price gaps in my free price action course, or you can wait for the next season of this SMC course. Moving on, vacuum blocks and liquidity voids can be classified into four major categories, depending on where they appear on the chart. And of these four, only two tend to get filled quickly. The others take some time to fill up. These include common liquidity voids and common vacuum blocks, exhaustion liquidity voids and exhaustion vacuum blocks, breakout liquidity voids and breakout vacuum blocks, and finally, we have runaway liquidity voids and runaway vacuum blocks. Let's briefly look into each one of them. Common liquidity voids and common vacuum blocks appear randomly on the chart. Often there is nothing more to their formation on the chart beyond their mere appearance. These are formed at random locations, or in other words, they have no underlying price action meaning in the market, or maybe not something that I know of. But one observation that I have made is that these common voids and blocks are formed within ranges. That is, when the market trades between a certain range, you will come across them. And 80 to 90% of the time, these liquidity voids and vacuum blocks get filled. Now moving to exhaustion liquidity voids and exhaustion vacuum blocks, these happen at the end of the trend. As the name suggests, these get formed when the market loses steam and is nearing an end of a particular trend. And when this happens, the market forms a vacuum block or a liquidity void, indicating a trend reversal. Now, talking about breakout liquidity voids and breakout vacuum blocks, as the name suggests, breakout voids and blocks happen when the price breaks out of a support, resistance, or a liquidity zone. After the formation of a breakout vacuum block or a liquidity void, price will most probably return to fill the imbalance and then move in the direction of the breakout. Finally, let's talk about runaway liquidity voids and runaway vacuum blocks. These are considered as continuation voids and blocks because of where they appear on the chart. These happen in a market with an already established trend and they appear in the direction of that trend. Runaway liquidity voids and runaway vacuum blocks don't fill on time as they often serve as continuation of the trend. So these are all the important things that you need to know about liquidity voids and vacuum blocks. In this video, we will delve into the premium and discount concepts, exploring their application in trading and how they can enhance decision making. We will also talk about the common mistakes that traders make, and finally, we will discuss PD arrays and the hierarchy of different reference points within the PD array. Understanding these concepts can help traders refine their entry and exit points, thereby maximizing the potential for profitable trades. So watch this video till the end to get a proper grip of the entire concept. If these series of videos are helping you to learn and improve, please make sure to like this video to show you valuable support. And don't forget to subscribe to our channel and also make sure to enable the bell notification to get the latest updates. So without wasting any time, let's get started. Premium and discount are simple concepts that apply to buying and selling things. This includes buying and selling instruments in the stock market or the forex market. Premium means expensive or markup, and discount means cheap or marked down. This is a basic trading principle that can be used in any market, from consumer goods to securities traded through exchanges or even forex. So, when you buy something at a premium, it means you're paying more than its fair value. On the other hand, buying something at a discount means you're getting it at a lower price than the actual value. These simple concepts can be applied to various products and assets that are traded in the market, such as stocks, currency pairs, or even commodities. If you look at this picture, you will see that markups and discounts can be applied to anything that can be sold on the open market, even if it's a pack of banana chips. The most optimal demand for a pack of chips will be 200 rupees. But as the price gets higher, the demand reduces, and vice versa, the lower the price, the higher the demand. This is simply the law of supply and demand. You can learn more about it in my Basics of Stock Market video. Now, this is quite logical because if a one-stop supermarket chain like D-Mart has a promotion for discounts on their different products, then you will see a lot of people flocking to buy these products like bees on honey. Now, when it comes to trading, premiums and discounts can be marked on a candlestick chart to determine the premium and discount levels within a specific range or price action. And you must all understand that a major player will never sell at cheap prices and they will never buy at higher prices. Premium and discount zones are places where majority of their sales and purchases takes place respectively. When marking premium and discount zones on a candlestick chart, you have the choice to apply this marking to any part of the price or range. Therefore, even despite the strategy you have chosen, you should strive to buy in the discount zone, that is when the asset is trading at a discount, and you should look to sell in the premium zone, that is after the asset marks up or becomes expensive. Think of it this way. When you want to buy something from Amazon or Flipkart, you will look for the best discount that you can get so that you can buy it at a price lower than the actual going price in the market. And when you want to sell the same product after some months in OLX, you will definitely look to get the highest price possible. That is, you want to sell it at a premium or at an expensive price than the actual going price in the market. Now let's learn how to draw premium and discount zones. For this, you will require three things: a swing high, a swing low, and a Fibonacci retracement tool. If you have watched my video on market structure mapping, you will definitely have a good idea on how to spot swing highs and swing lows in a chart. Here, the price is rallying higher. This is an impulse move towards the upside. The swing low is the lowest point in this entire impulse swing move. We will also have to include the wicks, if any. On the contrary, swing high is the highest point within the entire impulse swing move, including the wicks. Now once the swing high and swing low are identified, we can bring up the Fibonacci retracement tool from the left side toolbar section. Then select the swing low point that we have identified and drag the cursor and select the swing high point. This will automatically plot all the Fibonacci retracement levels. We don't require all these default levels, so we can select the Fibonacci settings and then uncheck all the levels other than 0%, 50% and 100% levels. Then you can click on OK. Now what we have are 3 levels. One at the swing low, one at the swing high, and another at the midpoint between the high and the low. Now the area below the 50% Fibonacci level is considered as the discount zone, and the region above the 50% Fibonacci level is considered as the premium zone. The 50% level is known as equilibrium or mean threshold, which is nothing but the fair valuation of the asset at that particular instance. This is the point where bearish premium arrays and bullish discount arrays meet. It represents a state of balance in the market where supply and demand are equal and the forces of buying and selling are evenly matched. Since the price is rallying upwards, our bias will be bullish. That is, we want to trade with the trend. So we will look for buying opportunities. But as I have stated earlier, we should always look to buy at the discount valuations or cheaper prices. So where will you get the cheapest price? Obviously, you should look to buy from the discount zone when the price makes a retracement or correction in order to get a markdown below the mean threshold. This doesn't mean you should take a long position anywhere in the discount zone. You should take buy positions only from one or more of those prices of interest or SMC reference points. This gives us additional confirmations for our trades. We will talk about these reference points and their relevance when we take up the PD array concept. Now look at the next scenario. In this case, the price has declined lower. This is an impulse move towards the downside. So the first step is to spot the swing high and swing low of this impulse move. Then use Fibonacci retracement tool to connect the swing high and the swing low. This will plot the retracement levels automatically. Now go to the settings and uncheck all those levels that we don't require. Just keep the 0%, 50% and 100% levels. So there is a level at the swing low, one at the swing high, and the last one is at the middle between swing high and swing low, which is nothing but the mean threshold or equilibrium. And above the mean threshold is the premium zone, and below equilibrium is the discount zone. Since the price is declining lower, our bias will be to sell. That is, we will look for short trading setups when price makes a retracement or correction towards the upside. And when we are looking to sell, we will obviously look to sell at expensive valuations or at higher prices. This means we should short above the mean threshold or in the premium zone. This is where prices are marked up above the fair value or equilibrium. Now you can't just sell at random prices within the premium zone. It doesn't work like that. You need to sell at any of the prices of interest or the SMC reference points which is already existing inside the premium zone for the best possible results. This will provide a high probability setup for us to work with. Now moving on, let us look at some issues with this concept, and we will also look at some of the common mistakes that traders make when using premium and discount zones. The truth is that most traders either rely too heavily on this tool to make informed trading decisions, or they use it in such market conditions in which it does not make any sense to use this tool. When using Fibonacci, you don't need to be Fib dependent or rely on the fact that when price drops into the discount zone, it should immediately begin to rise. And when the price rises to the premium zone, it should immediately stop and begin the downward movement. Keep in mind that price does not owe you anything and the market does not move according to your whims and fancies. It is true that price takes into account premium and discount zones, but the higher the time frame, the stronger is the possibility of it working out for us. The most common problem with premium and discount zones is that on lower time frames that are below 15 minutes, this tool becomes less effective if the price is not in its full range. It is also worth remembering that price tends to change direction even if there are these important zones on the way. So there is no real guarantee of a price reversal from these zones. While we believe that premium and discount are a great entry point tool, over reliance on it can cause you to incur losses and also miss out on quality trade setups just because they are not premium or discount. So, without conducting an in depth analysis of prices using concepts like market structure, supply demand zones, liquidity, etc., which help to get the idea of the market direction, it is not even worth choosing a Fibonacci tool to plot premium and discount zones. The other common mistake that traders fall into is using premium and discount zones in those markets or assets that are either extremely volatile or those which are trending strongly in one direction. A simple example is to choose a stock that tends to move in one direction over the long term but with a very high volatility. The price may fluctuate parabolically within an upward trend and it will not even think about falling into the discount zone. So the price may not always follow the expected pattern when it is in the premium or discount zone, especially in short to medium term trends. Another mistake committed by the less experienced traders is that they go chasing premium and discount zones everywhere in the charts and they will eventually end up on the wrong side of the trend. So do not chase premium and discount zones and do not go against the trend. And lastly, don't trade premium and discount zones within a consolidation zone. So it is important to note that there is no real magic in premium and discount Fibonacci tool. What matters most is the narrative, the story that the market is telling. Only with a clear understanding of the narrative can you use this zone as a framework for trading. This is where the significance of PD arrays come into play. PD arrays stands for premium and discount arrays. This is a central concept in SMC. An array is nothing but a specific arrangement of things. Now, premium discount array is crucial for understanding how the market has moved and how it might move in the future. It is like a detailed map of the market activity, showing traders where the price has been and suggesting where it might go. This array is particularly useful for identifying key levels of support and resistance, as well as potential entry and exit points for trades. PD arrays focuses on the analysis of price levels in terms of their relative value compared to the market's perceived fair value. In a PD array, price points are categorized as either premium or discount. Premium prices are those considered higher than the market's perceived fair value, indicating a potential overvaluation, while discount prices are seen as lower, suggesting an undervaluation. You already know how to plot these premium and discount zones. And as a matter of fact, you also know that this method of categorization allows traders to gain insight into the potential market turning points by identifying where the market might switch from a state of overvaluation to undervaluation and vice versa. But PD arrays are more than just premium and discount zones. This is a multifaceted analysis that helps traders to not only see what the market is doing, but also understand why it is doing so, thereby enabling more informed and strategic trading decisions. PD arrays also take into consideration some array items or reference points. Specifically, there are 7 array items or institutional reference points that we need to consider in a PD array. In ICT methodology, these reference points includes old highs and old lows, order blocks, rejection blocks, mitigation blocks, breaker blocks, fair value gaps, and liquidity voids. Old highs and old lows refers to the swing highs and swing lows that can act as potential resistances or support levels for prices respectively. Due to this reason, there will be liquidity in the form of retailer orders available beneath these levels. So old highs and old lows are potential areas where the smart money can manipulate prices to absorb the liquidity and then reverse the market direction. Other than this, I have given you detailed explanation on each and every single topic. You can watch and revise them by going to the SMC playlist. Now, there is a particular order or hierarchy or relevance by which each of these array items are organized within a PD array. But before I tell you the hierarchy of array items, I want you to remember that you need to conduct your analysis on your higher time frame charts no matter what trading style you follow. It could be swing, intraday, positional, etc. But this primary analysis should be done on your preferred higher time frame. This will definitely improve the quality of the trade signals. Once you receive a good setup, you can always move down to your lower time frame charts to optimize your trade entries. Now, let us look at the order of relevance of discount array items. We will only consider the discount zone when our trading bias is bullish. So for remembering this with ease, we can also call it a bullish discount array. Here, I have listed the bullish discount array items in the order of their relevance or hierarchy. So the most relevant institutional reference point is the old low, followed by a bullish rejection block, then a bullish order block, a bullish fair value gap after this, followed by a bullish liquidity void, a bullish breaker block thereafter, and the least relevant item is the bullish mitigation block. The hierarchy or relevance of fair value gaps and liquidity voids can be interchanged. Now, even though the relevance of these array items are in this particular order, we should start looking for these reference points in the opposite order. That is, we need to start searching for a bullish mitigation block first, followed by a bullish breaker block, and so on. There is a simple explanation as to why the relevance is in this order, but when looking for opportunities, we should go in the opposite order of the hierarchy. Look at this figure. I have marked some of the 7 reference points within a discount zone. Now, what do you notice? We can see that the old low is the lowest of all array items, located at the end of the discount zone. The next item is the bullish rejection block, followed by a bullish order block, a liquidity void, and a few fair value gaps within it. You can notice that one of the fair value gaps is closer to the equilibrium zone. It is clear that the reference points are arranged based on how cheap the price can become when compared to the mean threshold. So higher the relevance of an array item, the cheaper the price is available in the discount zone, which increases a trader's profitability and improves his chances of success. But you might already be aware of the fact that price will not pull back all the way down to absorb the liquidity. Price needs liquidity to move. It doesn't matter from where it gets it. This means the probability of price returning back to sweep the old low or the rejection block in a discount zone is much lower. Prices might reverse from an order block or a fair value gap. This is why we should look for the least relevant array items first, which is situated closer to the mean threshold, and then only look for other reference points which are usually formed deep within the discount zone. Another point to note is that not all these reference points will get formed within a discount zone. There might be occasions where you might get only a bullish order block and a bullish fair value gap. But there might be other situations where you might encounter a majority of these reference zones. So the idea is not to force yourself into finding these reference zones. If it is there, it will be visible to you. If it is not there, don't go searching for a ghost that does not exist. Now, once price trades below equilibrium, and if the overall narrative is bullish, it sets up buy conditions. You can look for long trading setups from these reference areas within the discount zone as it increases the probability of a successful trade. These reference areas are where buyers might step in to drive prices up from these discounted levels. These setups are identified when the price returns to the discounted conditions, allowing you to buy at favorable prices. Moving on, let us look at the order of relevance of array items in a premium zone. It is also called a bearish premium array because our bias is to go short in the market. Here, I have listed down the array items based on their hierarchy in a premium zone. So the most relevant institutional point on the sell side is the old high, followed by a bearish rejection block,
after which comes a bearish order block, a bearish fair value gap thereafter, followed by a bearish liquidity void, and then a bearish breaker block, and the last reference point is the bearish mitigation block. Here also, the relevance of liquidity voids and fair value gaps can be interchanged. Now, just like the previous case, we should start looking for the lowest array items in terms of priority because the price will not always retrace all the way back to grab the liquidity. It can sweep the liquidity available anywhere in the bearish premium array and then reverse lower. So start looking for the mitigation blocks first, followed by the bearish breaker blocks, the liquidity voids, and so on. Also, not all these array items get formed within the premium zone. So don't just assume things. Follow what you have learned and apply it. If it is not there, it is not there. As simple as that. The same concepts apply to short setups as well. When the market takes liquidity, forms a swing low, and trades above the equilibrium region, you can wait for institutional reference points like bearish fair value gaps, bearish order blocks, etc. These reference zones are where sellers might dominate, pushing the prices down from these premium levels. If the overall bias is bearish, you can take a short trade entry, which will present you with a high probability trade setup. So these are all the important things that you need to know about premium and discounts. It is important to keep in mind that premium and discount concepts should be used as a part of a comprehensive trading strategy. Traders should consider other factors such as market structure, supply and demand zones, and liquidity before making trading decisions. These concepts provide additional insights and can enhance decision making, but they should not be relied upon as the sole basis for entering or exiting trades. We have covered all the basic SMC concepts in a very orderly manner, giving emphasis to each and every concept. If you have not yet watched this series of episodes, I urge you to watch them because it could be the turning point in your trading journey. I will link the complete SMC playlist in the description and in the I button for easy access. Once you complete each episode, I want you to go back to your favorite charts and apply what you have learned. I want you to select the highest time frame for your chart analysis based on your trading style. Once that's done, I want you to mark the market structure. That is, identify the major swing structure and the internal structures. Then, I need you to figure out where to find the internal and external liquidity areas and see how the price reacts in these areas or zones. Further, I want you to identify and mark the major SMC reference areas. These reference areas could be order blocks, fair value gaps, rejection blocks, liquidity voids, etc. And finally, based on the market structure and the trading bias, you need to identify the premium and discount areas within a particular swing. This is how the entire SMC chart analysis process looks like in brief. As a beginner, you need to keep identifying and marking them manually. This will help cement the concepts in your head. The trade entry process is yet another topic of discussion which we will cover in the second season of SMC course. Now, analyzing multiple charts can turn out to be time consuming and cumbersome. So, we require some help. This is where indicators come into picture. So in this video, I will be talking about a few very useful and effective SMC indicators that will release a lot of burden when analyzing charts. Keep in mind that all the indicators that I will introduce to you are available for free in TradingView. So if you think this series of videos are helping you in your trading, all I am asking you in return is to like this video and share this video with your friends and fellow traders. And if you are new to this channel, make sure to subscribe and also enable the bell notification to stay updated on our latest videos. Before I talk about the SMC indicator, I would like you to select the highest time frame depending on your trading style. This time frame selection will vary from one trader to the other. If you know your trading style but you are unable to choose proper time frames, I suggest you watch my detailed video on how to select time frames accordingly. I am predominantly a swing trader, so the higher time frame for my analysis is usually the 1 day time frame. And if you are someone who trades intraday positions, you can choose your higher time frame as the 1 hour or even the 15-minute time frame. Once that is done, you will notice a problem in the chart. This is commonly observed in most Indian stocks and indices. It is nothing but price gaps. These gaps are a result of overnight market sentiment. These gaps become annoying when we start to mark the market structure. It does not provide a continuous price action, due to which structure mapping can get a little bit complicated. So, a simple workaround this issue is to use an indicator. Keep in mind that in forex and crypto markets, there is no requirement of this indicator as the price is continuous as the market is open almost 24/7. Now, let's take a look at this indicator. So, open TradingView in your browser or app, then open the chart you want to analyze. For this case, I will choose the Nifty index. Then I will select the 1 hour time frame, and you can see a lot of gap formations in the chart. Now go to the indicators icon and click on it. A pop-up menu will appear on your screen. On the left side of this menu, select the section named Technicals. Now, on the search bar, type in No Gap Candles and then hit Enter. You can see there is only one indicator available in that list, which is created by Ichipata. Just click on this indicator. Now go back to the chart and you can see how the gaps are automatically filled by extending some candles. Keep in mind that this indicator should not be used while trading or taking a position in the live market. This indicator should be used just to make the structure mapping process easier if you are a beginner or if the chart is too much crowded with price gaps. I will turn this indicator on and off so that you can see what really happens in the chart. You will instantly notice that gaps are filled just by extending one of the candles. So there is no real logic in doing so. Therefore, make sure to switch off this indicator once you have completed marking the structure. Now, if you go to the settings of this indicator, you will find that there are not really many adjustments to be made. Just keep everything as default, but maybe you can change the colors so that you can easily recognize where the price gaps were. Moving on, there are a lot of smart money related indicators available in TradingView indicator section. But the indicators that are used by a large number of traders are the ones created by LuxAlgo. Just go to the indicator section and on the search bar type in LuxAlgo and you will see hundreds of results showing up. There are some smart money related indicators, price action based indicators, and a lot of others. For the purpose of this video, our focus is only on smart money indicators by LuxAlgo. A special mention to LuxAlgo for keeping these indicators absolutely free for retailers. Anyways, I have starred or favorited some of the best SMC indicators by LuxAlgo. You can pause this video, take a screenshot, and type in the names and add these indicators to your favorite indicator section. These indicators provides a lot of flexibility for traders to choose only those concepts which are actually required for your trades. For example, if you want the indicator to spot potential order blocks and breaker blocks, then you can use the order blocks and breaker blocks indicator by LuxAlgo. But if you only want order blocks and don't want the indicator to spot breaker blocks, then you can select the order block detector indicator by LuxAlgo. And in case if you don't want the indicator to show order blocks but only spot breaker blocks, then use breaker blocks with signals indicator for doing so. So the scope of customization is endless. I won't go into each and every one of these indicators because it will then become a very long video and I don't want to waste your valuable time by talking about the indicator settings. It is actually not worth it. So I leave it up to you to play with these indicators. I think TradingView has now limited the number of indicators on the chart to just 2 for their basic plan. Now most beginners won't be able to afford TradingView subscriptions. Even I was not able to afford TradingView when I started out. For such people, using multiple indicators as a part of customization is not really a possibility. But fear not, there is an SMC indicator that is an all-rounder. It takes care of most of the useful SMC concepts, from mapping the external and internal structures to finding order blocks, fair value gaps, equal highs and lows, multiple time frame highs and lows, to figuring out the premium and discount areas. It will satisfy more than 90% of your requirements, and it will help quicken your chart analysis by multiple folds. The creator of this indicator is none other than Lexalgo himself. So go to the indicator section and on the search bar, type in smart money concepts. And in the results, you will instantly notice the first indicator by Lexalgo that is used by more than 40,000 traders. Just click on this indicator. It will automatically apply all the concepts on the chart. You will see a lot of markings like bows, chalk, equal highs, equal lows, strong lows, weak highs, order block zones, etc. After applying the indicator, the chart looks kind of crowded. So let's fix this. In order to do that, let us tap the indicator settings. Under the input section, you will notice a lot of options for customizing the indicator. Let us take a look at each one of them and understand what is what. So the first option says mode. By default, it is set to historical. If you click on the drop-down menu, there is another option named present. If you want to know what these options mean, just hover over or click on the I button on the right. It asks if you want the indicator to mark the historical structures also, or do you just want the recent structure formations. If you click on the present option, you can notice that all the previous markings are removed and only the most recent structure is marked. Personally, I like to keep this option set to historical as it gives me a general idea about the market trends and how it has played out in the past. The second option says style. By default, it is set to colored. Click on the drop-down menu and you will find another option named monochrome. Hovering over the I button, it says indicator color theme. If you select monochrome, every marking will be set to gray. It might help with keeping things simple, but if you want the markings to look more bright and colorful, choose the first option. It depends on your personal preferences. The next option is a tick box named colored candles. This option will color the candles based on the current trend as detected by the structure. Enabling this option also depends on your personal preference. The next section says real-time internal structure. This option displays the internal or minor market structure on the chart. The internal structure is not the major component in our analysis. But if you are someone who follows fast-paced trading styles, by entering and exiting positions quickly, grabbing only a few points, then internal structure might come handy for you. You have some customization options to change the color of the bullish and bearish internal structure markings, as well as filtering only bows or chalk or both. There is also a confluence filter that will filter out all the non-significant internal structure breakouts. For the time being, I will just uncheck the internal structure option. Once we do that, the chart becomes much more cleaner. Now, on scrolling down, the next section reads Real-Time Swing Structure. Enabling this option will display the major swing structure. You have a lot of controls available. First of all, you can decide whether you want the indicator to display just the bows or the chalk or display both. I will keep it as default. You can also change the color of the markings however you like. Then there is another tick box reading Show Swing Points. Enabling this option will mark the higher highs, higher lows, lower highs and lower lows. The default number is set to 50. You can increase or decrease this number to get the appropriate swing labels. The next tick option is to display the most recent strong highs or lows and weak highs or lows. This is also an important option, so keep it enabled. Keep in mind that the market structure mapping may not always be 100% accurate. There might be certain discrepancies, so make sure to double check the outputs. Now scroll down again. The next section is for order blocks. Here there are two options. One is for internal order blocks and the other option is for swing order blocks. The swing order blocks are considered as high probability, high reward to risk order blocks compared to the internal order blocks which are considered less effective. Both numbers are set to 5 by default. It simply denotes the number of order blocks to be displayed. You can change this number if you want. The next option says order block filter. By default, it is set to ATR. The drop-down gives an additional option to use the cumulative mean range as the filtering method. The I button clearly mentions that cumulative mean range is to be used only when the price data available is low, meaning this might come in handy on illiquid assets. Since our focus is only on liquid assets, we should keep the filtering method to the default setting of ATR. You also have the option to change the color of the order blocks so as to set them apart for easier identification. Now scroll down again. The next section is for equal highs and equal lows. Enable this tick box. Equal highs and lows help us figure out the market liquidity. The first option says bars confirmation and it is set to 3 by default. This is nothing but the number of candles used to confirm the equal highs and lows. More the number of bars required, lower will be the number of equal highs and lows marked, and vice versa. Keeping this number high can help us find more purposeful equal highs and equal lows. Setting this number to a very small value like 1 can basically return a lot of results on the chart, but they are noisy and less useful for us. So play with the numbers to find your sweet spot. The next option is threshold and it is set to 0.1. Not all equal highs and equal lows are formed perfectly. There will be some variations. This setting will help us account for this variation information and help us detect such equal highs and lows which are not perfect. Keeping a lower value like 0.1 can help us provide closer results and will return limited results. Keeping it to 0 will return perfectly equal highs and lows. Now when the sensitivity is increased to say like 0.5, it will return more results, but the variance of equal highs and lows formed will be higher. So try to keep this threshold value as low as possible. The next section is for fair value gaps. You already know what fair value gaps are, how they are formed, and how they work. Once the checkbox is enabled, the indicator will display fair value gaps on chart. The next option says auto threshold. Also enable this setting as it will filter out all those failed and mitigated fair value gaps which are not significant anymore. There is also an option to select the time frame in which the fair value gaps get formed. By default, it is set to the chart time frame. If you want the indicator to show fair value gaps from some other time frame for the purpose of taking confluence trades, then it is very much on the cards. You can also change the color of imbalances. Also make sure to extend the fair value gaps so that it is visible clearly. Turn up this number to 25 or 30 or more. On scrolling down, the next section is to select the multiple higher time frame highs and lows. Options for daily, weekly and monthly highs and lows are available. Enable all of them to get a reference of where the price is with respect to these levels. It gives an idea about overvaluation and undervaluation of prices. The last section says premium and discount zones. Once enabled, it will show the most recent premium and discount zones within a particular price swing. Keep in mind that it will not mark the PD arrays. It will only display the premium, discount and equilibrium zones to give you a general idea of where the price is trading at. Is it cheap or is it expensive? So that is all the input customization settings in this indicator. I would not say that the indicator is perfect and every marking is 100%. So make sure you double check everything. And if you have some knowledge on PineScript, the source code is also available for free and you can make changes to customize the indicator according to your requirements. You can also check out the other favorited smart money indicators and decide upon which ones to use. I hope this video will make your smart money analysis easier. And if this video was useful, please make sure to tap the like button and share this video with your friends and fellow traders. And if you are new to this channel, do consider subscribing. Also enable the bell icon to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you would like us to cover in our future videos. I appreciate your support and I look forward to seeing you in the next video. Till then, bye.